Ever wondered where banks get their money from? It's not just about storing your hard-earned cash. Banks are indeed far more than just a secure vault for your money. They function as robust financial institutions with a knack for generating profits in numerous ways that often go unnoticed by the general public. The anatomy of a bank's revenue stream is intricate and diverse. Banks are part of a system where they serve as intermediaries for financial transactions. The money deposited by customers doesn't just sit idle. Instead, it is utilized as part of a vast financial network where it is channeled into loans and other investments. These operations are the bank's primary source of income, as they earn interest on these loans. Additionally, another source of revenue for banks is trading and investments. Banks invest in various types of assets, including stocks, bonds, commodities, and real estate, among others, with the aim of generating returns. High-risk investments often yield high returns, boosting the bank's net income. Interbank lending is another key area that drives revenue. Banks lend money to each other to maintain liquidity and meet regulatory requirements. They earn interest on these loans, adding another layer to their revenue model. Forex or foreign exchange is also a significant sector. Banks earn from the difference in exchange rates between currencies. Not to forget, banks are also exploring new-age revenue streams like technology-based services, wealth management, and fintech partnerships to stay relevant in the changing financial landscape. The aim is to help you better understand the banking industry's revenue model. Ready to uncover the secrets of banking? Let's dive right in. At the heart of banking are the traditional activities we all know: lending and charging fees. Diving into lending, when you park your money into a bank, it doesn't remain idle. The bank utilizes your money effectively. Banks extend the money you deposit to individuals and businesses in the shape of loans. These loans take different forms, such as mortgages for homes, student loans for education, or business loans to fuel entrepreneurial dreams. These loans, when repaid, carry an extra component: interest. This interest is a proportion of the loan that borrowers return to the bank as a form of rental for using their money. It's somewhat like leasing money. The interest on loans is a crucial income source for banks. The larger the greater the interest they accumulate, moving to fees. Banks impose a range of fees for their financial services. Have you ever gone overboard with your debit card, resulting in an overdraft? That comes with a fee. Need to use an ATM that's not under your bank's network? That's another fee. And there are often monthly or yearly account maintenance fees. These may seem insignificant when considered individually, but when summed up across all bank customers, they amass a substantial source of income. It's important to keep in mind that while these fees may annoy customers, they are vital to a bank's functioning. They offset the costs of offering secure, convenient services such as online banking, ATM networks, and protection against fraud. Essentially, these fees can be viewed as a convenience fee. So, the simple act of keeping your money in a bank is already making the money, but that's not all. In the scene, we'll venture into the realm of investments and trading, exploring how banks employ these to generate more income. Stay tuned. Banks also make money from investments and trading, and it's not just about buying low and selling high. Let's delve into their methods. Banks deploy their assets to create more wealth. One strategy involves investing in securities, namely bonds and stocks. Bonds are loans that banks distribute to entities such as corporations or governments. The debtor repays the principal sum plus interest within a set span. Upon bond maturity, the bank profits. Conversely, stocks denote a fraction of a corporation's possession. Purchasing stock implies acquiring a part of the business. When the company prospers and its market value escalates, the stock price soars. Banks can then auction these stocks at a rate higher than the purchase price, leading to capital gains. Furthermore, banks gain from dividends, which are a portion of the company's profits shared amongst shareholders. By investing in stocks, banks not only benefit from capital gains, but also dividends. Switching topics, we'll discuss a practice called proprietary trading. Banks utilize their funds, not their clients, to deal in financial instruments such as stocks, bonds, currencies, commodities, and derivatives with an intent to earn direct profit. Proprietary trading is potentially profitable, but involves risks. Market flutters, economic changes, and political shifts can all affect the worth of the financial instruments banks trade. In case trades don't pan out as anticipated, banks might incur significant losses. Despite the hazards, proprietary trading is a substantial income source for banks. Several prominent banks globally have autonomous proprietary trading desks. These desks are manned by astute financial professionals who utilize their knowledge to forecast market movements and execute profitable trades. These activities can be risky, but they can also be very profitable. After all, in the world of finance, risk and reward often go hand in hand. Banks also lend money to each other, and they profit from foreign exchange transactions. Picture an interconnected world where banks aren't standalone, but part of a vast network. They partake in a complex ballet of lending and borrowing known as interbank lending. Here's how it works. A bank with surplus funds in one area and a shortfall in another doesn't let the surplus sit idle. It lends these funds to another bank in need, earning interest on the loan. This interest rate is often influenced by market conditions and the creditworthiness of the borrowing entity, thus helping the lending bank to profit. But there's another avenue for profit, and that's foreign exchange or forex trading. Consider a client who needs to swap their dollars into euros for a European business deal. The bank steps in to enable this, offering a rate that's slightly different from the market rate. This difference, called the spread, is where the bank makes a profit. Let's say the market rate is $1 to 90 cents euro. The bank might set the rate at $1 to 89 cents euro. That 1 cent discrepancy, when magnified by millions of transactions daily, turns into considerable profit. The banking world is far from siloed. Each transaction offers a chance at profitability. The world of banking is interconnected, and every transaction can be an opportunity for profit. In the digital age, banks have found new ways to make money. The advent of online and mobile banking bears witness to this shift. As a growing number of customers choose to bank from their smartphones or laptops, banks have responded by launching digital banking services. This wide of services encompass everything from basic mobile check deposits to intricate financial transactions. Banks capitalize on these services through a mix of fees and strategic partnerships. For instance, they may levy fees for priority transfers or earn a commission from a partner firm when a customer utilizes their service. Beyond this, another evolving revenue stream is the domain of wealth management and advisory services. As people and businesses amass wealth, they often require professional guidance to manage their finances efficiently. Here, banks step in to cater to this yawning gap by delivering a comprehensive set of wealth management services. These services often span from investment advice and estate planning to tax consulting. Banks generate revenue from these services via advisory fees and commissions. In certain scenarios, a bank might even charge a percentage of the total assets it manages for a client. These emerging revenue models do not just enhance a bank's income, but also diversify its revenue sources. This diversification fortifies banks against economic downturns and shifts in the financial environment. As technology to advance, so do the ways in which banks make money. So, there you have it. Banks generate revenue in numerous innovative ways. They charge interest on loans, levy service fees, participate in investments, and proprietary trading. Interbank lending and currency exchange in the forex market also add to their income. With the advent of the digital age, banks monetized online and mobile services, focusing more on wealth management. These diversified income sources make them resilient to economic fluctuations. Understanding how banks make money can indeed help you make smarter financial decisions. And if you found this video helpful, don't forget to like, share, and subscribe to our channel for more insights into the world of finance.